Hi, I'm Doug Jones at Mortgage Magic. People are always asking me, what's the interest rate? And there's no one answer. And I'm going to tell you why, because every rate is different for every customer. That's not discriminating, but here's the way it works. If a customer calls me, they want cash out, that's one rate. Now, that rate's going to be a little higher than a rate and term rate. And chances are that rate's going to be a little higher if they're purchasing. So a purchase is going to be a little bit lower, rate term can be a little bit higher, and then a cash out loan is going to be a little higher again. Then if the loan is owner occupied, they're going to live in the house, their primary residence, or if it's an investment property, that's going to be a different rate. The loan size is going to determine the rate. Above, in California, 760,200. Above that, up to 1,093,000 or somewhere in that range. There's two different rates, and beyond that, it goes to a jumbo rate. And then there's the loan to value, and the loan to value, the greater the loan to value, the greater the rate. Credit score is going to make a history on the rate. The history of the credit score is going to make a difference in the rate. And it's going to be difficult if the customer does not have sufficient amount of credit, even though he has a higher credit score. That could be a rate problem. The debt ratio, that's the income going to ALCO, has a rate that adjusts the rate. A W-2 or 1099, the type of income, self-employed people, that could make a difference. So there's a lot of things that can make a difference on the interest rate. But when most people are advertising interest rates, they're talking about the 30-year fix. And then there's other loans. So a 15-year fix is going to be a little less expensive than a 30-year fix because you're paying back quicker. A jumbo is going to be more than, that's a loan size, but a jumbo size is going to be more than a regular conforming 30-year fix. The FHA loan has its own rate. The VA loan has its own rate. Then there's the ARM, the adjustable rate mortgage. A 7 is fixed for 6-month ARM, and then a 10-6 ARM. So all these different kinds of rates are going to make a difference in what the individual customer's loan rate is. But there is a starting point, and the starting point for most banks is the 10-year T-bill. And you can see this on the Wall Street Journal or on the Google every day and see what the 10-year T-bill is sitting at, the rate of it. Right this minute, as a matter of fact, right this exact minute, is sitting at 3.761. Historically, the interest rate for a 30-year fixed is the 10-year T-bill plus about a 1.7 added on to that. So if we were doing historical right now, that would be a 3.761 plus the 1.7, the rate would be 5.46. However, the rate is right this minute again, 6.96. So why the difference? Because of inflation, because the Feds are moving interest rates, they're trying to get inflation under control, and because investors who are buying these T-bills or buying these investments, they're not going to take a risk, and they want to make sure that the financial market is stable before this can settle down and before they're really comfortable buying these securities. So the rate is going to change. I think what's going to happen is the rates have gone up now for about 2 years. As a matter of fact, this T-bill, this started a couple of years ago at 0.89. So now it's 3.76, started at 8.9. Then it went to, let me see, I got it here. It went to 1.45 the next year, and then 2.75 the next year. So it's gone way up. I'm predicting that this is July 2023. It will be very slowly, but I'm predicting that this will now start to go downward. So you can look forward to better interest rates. I'm Doug Jones. Give me a call if you have a question.